Good morning and welcome to the Killik podcast for Friday the 30th October. This week has been a good week for markets because the FOMC have been more positive about the global economy. So the great growth scare that we saw in the summer has now eased. The Fed are less concerned about global growth. They're more confident about the domestic economy and they're reassured and confident about the jobs growth on a cumulative basis, not too worried about the last two non-farm payrolls, which have been poor. So as a result, the market took the comments from the Federal Reserve as making it far more likely that we get a rate rise in December. So we've got a 50-50 chance of a rate rise coming through in December, which has big ramifications for the market. This week I think the market's gone up because concerns over stagflation have diminished, and we're also more calmed in terms of feeling that the central banks know what they're doing and they have a plan that they can implement. So as you can see here, we've had a big rally off that sort of low point at the end of the September quarter, and we're probably around 10% off that level. That's been helped by more sort of prospects of easing in Europe and the rate cut in China. But what's quite interesting is that having seen quite a big snapback and outperformance of the emerging market-based equities at the end of the quarter, coming into October, we started to see outperformance of developed market again. And that's probably reflecting the fact that the US economy and the interest rate cycle are back to sort of more normal sort of conditions. And so we could see people getting very negative about emerging markets again in this sort of scenario. Corporate profits and results continue to make the lured expectations bar that we had coming into Q3. I think it's been a pretty bumpy ride over the last couple of weeks in terms of results, and we've seen it from last week. Saw Travis Perkins, which fell pretty dramatically on their numbers. As well as saw the same sort of thing in Whirlpool and to a lesser extent in Goldman Sachs. But post those numbers, we've seen quite a strong rebound in the share price performances. So I think markets are nervous about corporate profitability peaking. And here you've got a chart that shows US corporate profits as a percentage of GDP. This is obviously at a sort of cyclical high level, and there are concerns that that's now going to start to fall as corporate returns start to fall because wages start to go up, interest rates start to go up. And I think that's why you're starting to see some of the volatility that we're seeing when companies are reporting, but you're still seeing the market buying into that weakness because the alternative is not particularly good. So bond yields are obviously still very low, and we still feel we're in an environment where the market and GDP will continue to grow. Next week we've got Deutsche Telekom, which I'm just picking out because we continue to like this cyclical and structural growth story. We had numbers from T-Mobile this week, which were very strong in the States. Deutsche Telekom own a big chunk of T-Mobile. And we also had numbers from BT, which is another telecom stock that we hold. The more important thing for BT in our minds was that they've been given provisional approval for the purchase of EE. This is an extremely important deal for BT and will mean that as a group, BT and EE, they will produce around 54% of the cash flow coming out of UK telecoms businesses. So they're a very big part of an important industry in the UK. They're also, post the synergies, once these two entities have combined, have a free cash flow yield of about 9%. So we can see a scenario where Deutsche Telekom, who will own 12% of BT post the EE deal, could be acquirer for BT. And that really does sort of focus on the core argument for owning these stocks, because we're seeing convergence and mergers in European telecoms industry, and that's going to raise the margins across the group. So next week, again, another hugely busy week for stocks. So Monday, HSBC, Visa, Church and Dwight. We've got Weir on Tuesday, Marks and Spencer's, Glencore, Wednesday, Michael Kors, Whole Foods Markets, Thursday, TripAdvisor, Walt Disney, Heidelberg Cement, Deutsche Telekom. Of particular interest in terms of core holdings, we've got Visa, we've got Walt Disney, so we'll be looking to see what they do. Heidelberg Cement is also particularly interesting in terms of a consolidation play. We're seeing big consolidation in the global cement market, and we feel that Heidelberg Cement is probably trading at about 7 times synergies post their acquisitions, so it looks particularly good value. So that's it from me. Have a good weekend. Thanks for listening.